What if I told you that you're only capturing half of SCHD's potential? Most investors simply buy the entire ETF and wait for those quarterly dividends, but they're missing a major opportunity hiding in plain sight. Ever felt like you're leaving money on the table with your dividend investments? In this video, I'll show you how to potentially double your SCHD dividend payouts by strategically targeting its most undervalued components. This approach focuses on amplifying returns from what you already own rather than chasing new investments. By the end, you'll discover how to unlock hidden value that most dividend investors completely overlook in their quest for passive income. You're doing everything right with SCHD, but there's a critical flaw in your approach that most investors completely overlook. It's not about the fund itself, it's about how you're buying it. SCHD has become a favorite among dividend investors for good reason. With a 4.05% yield, an incredibly low 0.06% expense ratio, and an impressive 208% all-time return, it checks all the boxes for quality dividend investing. Many investors simply buy shares, set up automatic investments, and watch their dividend income grow quarter after quarter. But here's the issue. When you purchase SCHD as a complete package, you're creating a serious limitation for your portfolio that's costing you money. The fund's methodology focuses on financial strength and dividend history, screening for companies with consistent payments and solid dividend growth. These criteria help ensure quality investments, but SCHD completely ignores the current valuations of the individual stocks it holds. When you buy a share of SCHD, you're essentially purchasing all 101 stocks regardless of whether they're trading at premium prices or significant discounts. This is like buying a pre-made meal kit when some ingredients inside are overpriced while others are on sale. You're paying the same price for each component, even though some might be significantly overvalued while others represent incredible bargains. This valuation-blind approach means you're potentially overpaying for certain stocks while missing opportunities to load up on undervalued companies offering higher yields and better growth potential. Consider this reality. When you purchase SCHD, you're not equally exposed to all holdings. The fund's top 10 positions make over 41% of the entire ETF. This concentration magnifies the impact of any overvalued positions among those top holdings. If major components like these are trading at premium prices, it can significantly drag down your overall returns and limit your dividend income. What if you could maintain all of SCHD's quality standards while being selective about which components you actually purchase? What if you could focus your investments on only the most undervalued companies within SCHD? You could capture the same dividend reliability, but with potentially double the yield over time. Think about it. Would you pay the same price for two identical houses in the same neighborhood if one was selling for 30% less? Yet that's exactly what happens when you buy SCHD without considering the valuation of its components. You're buying both the bargains and the overpriced stocks in one package. Now that we understand the problem with the standard approach to investing in SCHD, let's examine exactly how much potential return you might be missing. The numbers might surprise you, and they certainly make a compelling case for a more strategic approach to dividend investing. What if I told you the difference between average and exceptional returns comes down to a single number most SCHD investors ignore? That number is valuation, and understanding it could be the key to dramatically increasing your dividend income over time. SCHD has delivered solid returns of 57.42% over the past 5 years, but this broad performance masks something crucial: the significant performance gap between its most and least valued components. The data reveals investing in just the most undervalued quintile of SCHD stocks has historically outperformed the full index by 3 to 5% annually. That 3 to 5% advantage works like a hidden turbo boost on your investment vehicle. While it might seem modest initially, This performance edge transforms through compounding into nearly double the returns over a 10 to 15-year period. We can see concrete examples within SCHD's current holdings. Verizon, VZ, a significant component of SCHD, trades below its 5-year average PE ratio while offering a dividend yield above 6%, substantially higher than SCHD's average yield of around 4%. By targeting undervalued components like Verizon, you could boost your effective yield by 50% or more without sacrificing quality. Similar valuation gaps exist across multiple sectors within SCHD, particularly in healthcare and energy companies. These sectors experience cyclical valuation changes, creating windows of opportunity for strategic investors to capture higher yields and greater capital appreciation potential. These opportunities expand during market volatility, when valuation disparities widen significantly. Quality companies can see their valuations compress far below historical averages, even while their fundamentals remain strong, creating enhanced opportunities for investors who recognize these temporary disconnects between price and value. The standard approach to SCHD investing, simply buying the entire index and holding, leaves significant potential returns untapped. By spreading capital evenly across all holdings, regardless of valuation, investors forfeit the substantial advantage of focusing on the most undervalued components. By identifying and targeting these undervalued components, you can potentially double your effective dividend yield over time. This approach works within the framework of companies that have already passed SCHD's rigorous quality screens. You're optimizing your exposure to already vetted, high-quality dividend players. The beauty is that this strategy doesn't require abandoning SCHD's methodology or taking on excessive risk. It means being selective about which SCHD components you emphasize based on current valuation. Now that we understand what's at stake, potentially doubling your dividend income through strategic component selection, let's look at exactly how to identify these undervalued opportunities within SCHD. The process is more straightforward than you might think, and can be implemented by any investor willing to look beyond the surface of the index. What's the difference between investors who capture average returns and those who double their dividend income? It's not luck or timing the market. It's having a systematic approach to finding value. The best dividend investors don't make decisions based on hunches or headlines. They follow a methodical process that consistently identifies opportunities others miss. Identifying undervalued SCHD components requires a structured approach that eliminates emotion and brings consistency to your investment decisions. Most dividend investors fall short because they lack a reliable system for screening and evaluating SCHD holdings. Without a repeatable process, you're essentially guessing which components might outperform. Here's the 5-step system that transforms random stock picking into disciplined value capture. Step 1. Screen all 101 SCHD holdings for valuation metrics. Identify stocks trading below their 5-year average PE ratio with dividend yields above their 5-year average. This narrows your focus to potentially discounted companies. Using FinViz, you can create a custom screen with these parameters. Set the PE filter to below 5-year average and dividend yield to above 5-year average to quickly identify candidates. Step 2. Verify quality indicators remain strong to avoid value traps. Check debt-to-equity ratios, dividend coverage ratios, and confirm return on equity and cash flow trends are stable or improving. Step 3. Establish clear entry points based on historical valuation range. If a stock historically trades between 15 to 20 times earnings, set an entry target at a PE of 15. Create alerts for when these price targets are reached to act systematically rather than emotionally. Step 4. Implement smart position sizing. Allocate more capital to stocks with greater undervaluation while maintaining sector diversification. If Verizon appears 30% undervalued while another component is only 10% undervalued, you might allocate 3 times more capital to Verizon, while still maintaining sector balance. Step 5. Create clear exit criteria by defining when a position has normalized in value. Set profit targets or valuation levels that trigger a sell decision. Having predefined exit points removes emotion from selling decisions. This systematic approach provides data-driven methods to identify and capitalize on valuation opportunities within a pre-screened universe of quality dividend payers. By following these steps, you transform guesswork into a disciplined strategy that can significantly improve your results. With our selection system established, you now have a reliable way to identify the most promising opportunities within SCHD. But having a great selection process is only part of the equation. Next, let's explore the 3 specific strategies for implementing this approach in your own portfolio. The difference between knowing what to buy and actually implementing a successful strategy comes down to these 3 proven approaches. You might have the best stock selection system in the world, but without a clear plan for how to deploy your capital, you'll struggle to see meaningful results in your portfolio. Let's explore 3 effective strategies for putting our 5-step SCHD component valuation system into action, each designed for different investor preferences and risk tolerances. Strategy 1 is the core and satellite approach. This method involves keeping 70 to 80% of your portfolio in SCHD as your core holding, while allocating the remaining 20 to 30% to the most undervalued individual components identified through your valuation screening. This balanced approach provides stability through the core SCHD position, while satellite positions in undervalued components offer enhanced return potential. Consider Mark, a retiree who maintains 75% of his dividend portfolio in SCHD while using the remaining 25% for individual positions in companies like Verizon, currently offering a yield exceeding 6% with a forward PE below its 5-year average. This conservative strategy allowed him to maintain steady income during market volatility while capturing additional yield from undervalued components. Moving on to a more active approach, Strategy 2 is the valuation-triggered approach. With this method, you create a watch list of all SCHD components and only invest when specific valuation triggers are hit. For instance, set a rule to buy when a quality component's PE ratio falls 20% below its 5-year average, provided the dividend remains stable or grows. This systematic entry method removes emotion from buying decisions and ensures purchases only at significant discounts. Sarah, a data analyst, programmed alerts for her watch list and patiently awaited until Amgen hit her valuation target during a healthcare sector pullback. Her disciplined approach resulted in buying quality dividend payers at bargain prices throughout 2022's market correction. If you're comfortable with broader market analysis, consider Strategy 3, the sector rotation approach. This strategy involves identifying and overweighting undervalued sectors within SCHD relative to their historical averages. By temporarily allocating additional capital to discounted sectors, you can potentially capture returns as valuations normalize. David, a former financial advisor, noticed healthcare stocks within SCHD trading at historically low valuations last year and increased his position in healthcare components. When the sector rebounded, his portfolio outperformed the broader SCHD returns. Each strategy offers unique advantages based on your investment style. The core and satellite works well for conservative investors valuing stability. The valuation-triggered approach suits those preferring clear entry points. The sector rotation approach appeals to investors comfortable with broader allocation decisions. Before implementing any strategy, it's important to address potential risks. Even the best strategy requires proper risk management when targeting undervalued companies. What separates successful dividend investors from those who underperform? Understanding and managing critical risk factors. Our strategy for doubling SCHD dividends has significant upside potential, but we need to address specific risks to ensure your success over the long term. When you target undervalued stocks, you face several challenges that can derail even the best strategy. Let's examine the most common pitfalls, concentration risk, value traps, and tax inefficiency, and how to manage them effectively. Concentration risk occurs when too much of your portfolio depends on a small number of stocks. The simplest protection: limit individual positions to 3 to 5% of your portfolio and maintain exposure across multiple sectors. SCHD itself has significant allocations to consumer staples, healthcare, energy, and technology, so consider these existing exposures when selecting individual components. Value traps are stocks that appear cheap but have underlying problems that could lead to dividend cuts. The best defense is monitoring dividend coverage ratios and free cash flow trends quarterly. Take the case of John, a retired investor who noticed Kraft Heinz's declining cash flow coverage ratio in 2018 and reduced his position before the company slashed its dividend by 36% in 2019, preserving his income stream while other investors suffered significant losses. Tax efficiency can dramatically impact your real returns. Consider implementing this strategy in tax-advantaged accounts like IRAs or 401ks, particularly if you're in a higher tax bracket. This simple adjustment allows dividends to compound without being eroded by taxes. SCHD's structure creates unique opportunities through its quarterly rebalancing and annual reconstitution. The March reconstitution often creates temporary mispricing as stocks are added or removed from the index. When new companies join SCHD, they sometimes experience price increases as fund managers purchase shares. Conversely, removed stocks may temporarily decline, creating buying opportunities if fundamentals remain strong. The fund's relatively low turnover rate of 20 to 25% annually makes it tax efficient, but also means it holds components even when valuations become less attractive. This is precisely where your selective approach adds value. By managing these risks properly, you maintain SCHD's quality foundation while enhancing returns through strategic stock selection. You're simply being more selective about implementation while preserving the core principles that make SCHD attractive. Approach this strategy systematically rather than emotionally. Use these risk management techniques to protect your capital while positioning yourself to capture higher yields from undervalued components. This balanced approach helps ensure you don't take excessive risks in pursuit of higher returns. Now that we understand both the potential and the pitfalls of our strategy, let's wrap up with the key takeaways that will help you implement this approach successfully in your own portfolio. SCHD provides a solid foundation for dividend investors, but you can potentially double your income by strategically targeting undervalued components. The systematic approach we've covered maintains quality while enhancing returns through selective investment. The best dividend strategy requires truly understanding what you own. Recognize value when it appears. Start with a small portion of your portfolio using one of our 3 approaches and gradually expand as your confidence grows. Your path to enhanced returns begins now. Imagine the confidence of knowing exactly what drives your portfolio's performance. Take the leap today. Will you continue with the entire SCHD basket or start capturing its hidden value?